Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, March 15th, 2017. I don't think a lot of people will be surprised that I say that there was, quite big outflows this week, about $21 billion from the conventional fund business. We'll be talking more about ETFs as well, but this is just kind of focusing on the retail side at first. A second week in three that we've seen outflows, and it really was a rather good week. We had really strong non-farm payroll report come in. We had some other good news, but I think people were really taking a cautious approach ahead of the Fed. After the non-farm payroll and after CPI came out much higher than people had expected, these two events actually put people on pause and said, wow, is the Fed maybe going to do four rate hikes this year? And so they were a little bit conservative, and I think after the Fed did come out, raised the rate by 25 basis points, and basically had what I'm going to call a very dovish statement afterwards on inflation, I think people might have backed off a little bit, but certainly it played into the flows this week, and we'll get into details as we take a look at our macro groups. So we take a look at our macro groups. Equity funds lost about $6.2 billion, and not anything to write home about. No records out there, but certainly a concern. We see kind of just the opposite on the ETF side. We'll talk again more on that later on. Taxable bond funds saw about $3.9 billion flow out of their coffers. Muni bond funds, a little bit over $100 million came out of their group, and then money market funds, I guess you might call the pariah of the group once again. About $10.7 billion in outflows for the week. Well, let's take a focused look at the equity funds to see what happened in that group. If we take a look at them, they actually had plus side return, 1.37% return. So we really had some good numbers, and it was the fifth week in six actually that we've seen plus side returns, but we still saw outflows, about $6.2 billion. Fifth consecutive week that we've seen outflow from this group. And if we break it out, we take a look at domestic equity funds, as we have been, $3.9 billion in outflows in that group, and that's 11th consecutive week, even though they had a 1.10% return. If we take a look at the non-domestic equity side, $2.3 billion in outflows, and this is the first week in six that they've seen outflows, and they had a 1.97% return. So investors weren't looking at returns, they weren't chasing returns, they really were concerned on what was happening in the market. If we break this down just a little bit further, we saw that large cap growth funds, or just large cap funds overall, saw the biggest outflows out of the group, about $2 billion, and global equity funds also saw outflows as people were kind of getting away from the domestic side of that international group, right? So global equity funds, about $1.7 billion in outflows there. Let's take a look at what happened in the ETF universe, and it was quite a different story. We saw about $7.1 billion in net inflows, and at the top of the group, as we've seen in many times past, when markets seem to be doing okay, Spider S&P 500 took in about $3 billion, iShares Core S&P 500 took in about $1.1 billion, and PowerShares QQQ Trust 1 is at the very bottom of the group, lost about $780 million, and then the last piece, iShares MSCI Japan funds, actually saw outflows as well, about 438. So really there was quite a tale of two cities when we're taking a look at the retail investors and the ETF investors. ETF investors, authorized participants, were much more sanguine with the news that was coming out with the Fed raising interest rates. It certainly was saying that the economy is tooling along. And then afterwards, that positive statement by the Fed, saying, listen, we are going to stay steady on our interest rate hikes. However, we're not going to add any, and they didn't think inflation was that big of a concern. So Janet Yellen kind of put some of that unrest to rest after the meeting notes came out, right? Not the notes, but the statement came out. Let's take a look at what happened in fixed income funds. This is actually kind of a change of pace. For the first week in 11, we've seen outflows. $3.9 billion came out of the coffers. Seventh week in 8 that we've seen plus side returns, 0.23%. But if we take a look at where the money actually went, we saw that the international global debt funds saw the biggest inflows, about $700 million, third consecutive week they've seen inflows. And also loan participation, as we'd anticipate. Loan participation and inflation protected securities took in money. Loan pars took in about $840 million, and it's the 18th consecutive week they've seen net inflows into that group. And then if we look at the very bottom, where we've actually had some of the big moves, high yield funds, about $3.5 billion came out of the group, second largest on record that we've seen since we've been collecting weekly flows for this group since 1992, only to be preceded by and only bested by, if you want to call it that, by outflows that occurred in, I think it was August of 2014. So investors are really concerned about this rising base, treasuries, interest rates popping up, and they're going to demand a higher yield spread. So we think that's kind of what may be going on with the high yields, because certainly there's a trend we'll see here next in the ETF universe as well. So let's turn our attention back to the ETF universe now. They've seen about $1.1 billion in outflows. Second consecutive week they've seen outflows. And at the top, we saw the iShares 20-plus Treasury bond taking about $570 million. And people might go, well, weren't interest rates on the rise? Well, usually when we get these short interest rate rises, we get kind of a leveling or a flattening of the curve, which we are seeing. And so the short treasuries actually went up in yield, and we've seen kind of either a stagnation or a little bit of tilt downward at the longer end of treasuries as well. So that certainly was part of that story. iShares Core U.S. aggregate funds actually took in money too, about $292 million. And at the very bottom of this group, Spider, Barclay, high yield, a bond ETF, so about $1.2 billion in outflow, and that's kind of that connection that we've made between the retail markets and ETFs. People are shying away from high yield products, and certainly that was the case this week. Let's turn our attention now to muni bond funds. Muni bond funds, again, only lost about $149 million. Third consecutive week they've seen outflows, and it's the second consecutive week they've lost money on a performance basis, 0.06% minus as far as returns go, so really not a lot to fret about. But what we saw a little bit of difference here was high yield muni bond funds actually took in $63 million. So people still are apparently looking for yield, and I guess there's probably not as much concern with defaults and the like in that area. So they basically did that. It's the 10th consecutive week, though, that high yields have actually seen net new money come into their group. And if we take a look, though, at the bottom of the barrel where kind of the money came from, national munis lost $34 million. That would leave the majority of that money that got lost in single state muni bond funds. Now let's turn our attention back to money market funds. As I told you, we had big outflows, second week in three, $10.7 billion. This is not an unusual thing for us to see in March and April. We get into the corporations having to pay taxes. We get into, when we get into April, we'll get into individual investors having to pay taxes. So we always see a lot of volatility, a lot of outflows out of money market funds. Taxable money market funds actually saw about $10.7 billion of outflows, while tax-exempt money market funds saw just about $21 million in inflows. But if we take a look at the taxable money market side, we see that institutional investors pulled out $14 billion, while the retail investor actually parked some money, $3.3 billion into that group. Well, that brings us to the end of our conversation, but we really heard some good news again. I mean, this whole week has actually been pretty solid economic news. Housing starts rose better than expected. I think where the concern is going to be is obviously trying to read the tea leaves of what the Fed's going to do here going forward. Are we going to have 3 more cuts? If we are, 3 more rate hikes or 2 more rate hikes this year, 3 total. Will that impact more outflows from high yield funds? We'll have to keep an eye on that. But if you want to do a deeper dive into areas that I have not covered, you can go to our website, www.usfundflows.com, and lipperusfundflows.com, or you can join us next week where one of our analysts will talk about the flows of the week. Happy St. Patrick's Day to all my Irish friends out there. I hope you have a great day, a great weekend, and we'll check you out next time. My name is Tom Roseen. Thank you for joining me today. Wishing you the best in your wealth planning and creation.